day, fellow investors. Adobe is a stock that is always hot, and especially when it drops, a lot of you want to see it discussed. And let me give you a superficial analysis of Adobe. Why superficial? Because whenever I analyze something, I get to a point, okay, this is too risky for me, therefore I'm not interested. However, there are always comments. If people disagree, they never say, Sven, this, and this will overweigh on other things. They always say, my research is very superficial analysis. They say, you should have dug deeper rather than superficially bruising it off. This was in the case of Western Union, stablecoin strategies, tokenization, shysters, as Ken Griffin called them from Citadel. So that's all that I need to know. It might work, it might not work. Same as with PayPal. Let's look at the same brush on Adobe, because I go as deep as I need to know whether it might compound my wealth long term. That's it. And the first funny thing here is, so I made a 5% dividend yield earnings compounding video long-term wealth maximization. What is the comment? Adobe is approaching 300. You should take another look at it. Why? Because despite that I gave the best advice YouTube gurus have ever given, which is compound no matter what at 6.53 of that video, this is what everybody sees. Adobe is down. If it goes up, and Wall Street analysts are telling you it will go up 50% like that, everybody is looking at that 2x instead of focusing on compounding. Analyst targets are 450, we'll discuss that, but perhaps it will compound. Maybe I'm looking at the long-term trend and compounding, not whether it might 2x. We already discussed it 7 months ago. Okay, it's even cheaper now. And there was this Max Investor presentation, 3-hour presentation of Adobe, all the businesses, the ecosystem they are making, all great. And then the confirmation of the guidance of the year. And then we can first start with this GAAP and non-GAAP earnings. So there is a huge difference here, and this is something that you must always adjust when it comes to these tech companies, because it's simply not fair. And here is the adjustment: GAAP diluted net income per share, and then stock-based and deferred compensation expense, huge chunk, and they simply increase their earnings for 20 something percent. 1998, Warren Buffett, Berkshire Hathaway conference. One very real expense that executives love to ignore. Stock-based compensation is the most egregious example, Buffett said. The very name says it all. Compensation. If compensation isn't an expense, what is it? And if real recurring expenses don't belong in the calculation of earnings, where in the world do they belong? But Adobe is using it, and this you have to adjust as an Alice in Wonderland outcome, because existing accounting principles ignore the cost of stock options when earnings are being calculated. Even though options are a huge and increasing expense at a great many corporations. In effect, accounting principles offer management a choice: pay employees in one form and count the cost, or pay them in another form and ignore the cost. True Buffett. We'll be missing him. And if we look at the forward P ratio, it's just 15, 16 for a great growth company that must be cheap and therefore a great buy. So if I adjust to this, we are already at 20. I don't think the growth will be 10-20% next year. What will be the growth is now the key question when it comes to Adobe investing now. Can I know how much will be Adobe's growth? 8%, 15, 0%? I think anything can be right. Probably over the next 5 years, all 3 growth scenarios will be hit. 8% likely average, 15% might be possible on some new momentum, but that growth story can even be over for now. 0% on technological improvements, lowering prices, seat losses, because now AI can do everything, which means you don't need a 10-person marketing department, you need a 1-person, whatever creative department. That is the key thing with the new technology developing. And let me show you a short that I recently made that perfectly explains how the technology might affect this. In the book Poor Charlie's Almanac, Charlie Munger discusses AI investing already, even if it was discussed 20, 30 years ago through his speeches. There is this example where Munger recounts a story where Warren Buffett was told that a new loom had been invented, which would double the productivity in one of the textile mills owned by Berkshire Hathaway, or its precursor. And one day, the people came to Warren and said, they've invented a new loom that we think will do twice as much work as our old ones do. And Warren said, gee, I hope it doesn't work, because if it does, I'm going to close the mill. So new tech is great. However, you need to spend a lot of capital. Everybody else also have it. And when everybody has the new tech, who gains? Only the consumer, because nobody makes money. So this book is full with such gems. That's essential. Charlie Munger and Warren Buffett investing, and it tells you all you need to know to invest in whatever environment, to compound your wealth long term. The company might grow, but if there is no profitability because of the new tech, okay, then I am asking myself, is there a margin of safety when it comes to this business? And I don't think so, because the P ratio might go to 10, but all the earnings will be invested in new growth opportunities like they did the recent Firefly, or what was it, acquisition. Earnings goes into compensation, things like that, and there is no margin of safety, and the growth going forward is uncertain. Let's look at what analysts have to say. Wall Street analysts are positive. Piper Sandler, 470 price target, overweight, so rapid pace of innovation at the recent conference, but acknowledge the AI existential threat might to continue to weigh on the stock or on the business near term. So that is, again, a big question mark here, especially given AI adoption and monetization remain in the early innings. Stifle, 480 price target on Adobe. So all good, Gen AI, it will change. But the waters ahead remain muddy as forward-looking fears around seat counts in creative departments and competition are difficult to disprove. So again, it is a bet. RBC Capital Markets, 430 price target. So long-term strategy, but then with this AI, it's all a new strategy, all new worlds. I'm amazed at what AI can do. Even ChatGPT can make great art and things like that. So you might be able to get your things, and my editor also told me, much cheaper elsewhere rather than paying the full Adobe package. So Adobe is likely not going away. However, the economics of the business, because of AI, might be going away. So that is a big question mark for me. I don't know. I don't think anyone knows. The analysts are always exuberant, always playing into the current trend, but they are just saying there is this risk, and if we're wrong, they don't care about it. They are not invested. So I can look at these bets or simply wait for simpler. And I don't need many investments. I need to find 5 compounding vehicles in a decade. Of those, I just need 2 to be at the right price in a decade. And that's all I need. That's why 99% of the cases, a superficial analysis is completely enough. If the investment isn't simple, why would I need that one? I can decide how can I compound my wealth. Yes, you can play around with the 2x's, things like that, but that's it. Why do I do analysis even if that? Because for some of you, I know it's very valuable. And then what would be this YouTube channel if I did 2 videos in a decade? you would not even know about me. So it's about the philosophy, the strategy. I'll keep doing superficial until I find something where, wow, 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 wow. And then you make a deep dive, then you start following it over time. And then it might hit great buy, margin of safety, long term compounding. And that's what we are looking for.